For most people, currencies only matter when they collapse. But by the time a collapse is visible, the real shift has already happened. Right now, the global currency system is changing quietly, not through panic, not through headlines, but through steady repositioning. At the center of this shift is the US dollar. Over recent weeks, the dollar has weakened against several major peers. This has not been driven by a single event. It has been driven by confidence, risk perception, and capital flow behavior. According to reporting from the Financial Times, renewed geopolitical tension and trade uncertainty have revived what traders call a sell America trade. That phrase does not mean investors are abandoning the US. It means they are reducing exposure at the margin. And in currency markets, margins matter. Currencies respond before equities. They adjust before earnings. They reflect expectations, not outcomes. When investors expect higher uncertainty, they rebalance currency exposure first. This is what we are seeing now. The dollar's movement has not been dramatic. That is what makes it important. A slow decline signals redistribution, not panic. While the dollar softens, the pressure does not disappear. It moves outward. Emerging market currencies are absorbing that pressure. In Indonesia, the rupiah recently moved toward record lows. The driver was not inflation data or growth collapse. It was concern over central bank independence. When markets question whether a central bank can act freely, confidence weakens immediately. This reaction was reported by Reuters, and it reflects a pattern seen repeatedly in currency history. The currency moved first. The explanation came later. India's rupee shows a similar but distinct pattern. Reuters reports that the rupee has been drifting toward record lows, not because of domestic crisis, but because of persistent demand for dollars. This is important. It tells us that even when fundamentals remain stable, global dollar demand can still overpower local strength. The Reserve Bank of India has intervened selectively, signaling restraint rather than defense. This is how modern currency stress works. It does not arrive as a shock. It arrives as pressure. South Africa's rand tells the same story from a different angle. As global markets move into a risk-off posture, capital tends to leave higher-yielding currencies first. The rand weakened as investors waited on economic data and reassessed global exposure, according to Reuters. These currencies are not collapsing. They are adjusting. An adjustment is how currency systems stay intact. What connects these cases is not local failure. It is global repricing. Currencies operate inside a hierarchy. When the top shifts, everything below responds. At the same time, structural changes are happening in Europe. In 2026, Bulgaria formally joined the euro area. This was not a market reaction. It was a policy outcome years in the making. The move brings another economy under the European Central Bank's monetary framework, expanding the euro's institutional footprint. This was confirmed by the Financial Times. Euro adoption is not about short-term exchange rates. It is about long-term credibility. For currency markets, credibility is weight. Every addition to a currency block strengthens the system behind it, not instantly, but structurally. This matters because currency power is no longer only about interest rates. It is about governance, predictability, and policy continuity. The dollar still dominates global trade and reserves. That fact has not changed. What has changed is how sensitive markets are to political and geopolitical risk. When risk rises, investors no longer move in unison toward the dollar. They diversify. Some capital flows into other reserve currencies, some flows into commodities, some moves into cash held outside traditional exposure. This does not weaken the dollar overnight. It dilutes its exclusivity. Currency dominance fades quietly. It does not announce itself. Historically, major currency transitions follow this pattern. First comes reduced dependence, then increased alternatives. Only much later does pricing reflect the change. We are still in the early stage. Nothing is breaking, nothing is collapsing. But positioning is changing. That is what currencies are telling us. The foreign exchange market is not emotional. It is mechanical. When uncertainty rises, it reallocates. When confidence narrows, it spreads risk. Right now, the signal is not fear. It is caution. A weaker dollar in this context does not mean failure. It means adjustment to a world where capital no longer assumes one default destination. This is not a prediction. It is an observation. Currencies are moving first. Narratives will follow. And by the time those narratives arrive, the positions will already be set.